It's that time of year. Everybody wants to know what's in store for the 2026 housing market. Instead of our regular weekly market data update, we've just published something we've never before done at Compass, our first ever comprehensive housing market outlook report for 2026. This report is actually much more than a forecast. It's 70 pages of deep research where we look at the forecast for prices and sales, but we also dive into the big themes that are shaping the market today. We explore alternate scenarios. So when you have your take on what's going to happen in the housing market next year, we've probably examined it, looked at the data, and helped frame it with all the dynamics underway right now. We have a very cool website where you can see the highlights for the report and download the full report. So I will link to that below. In this video, I'm going to give you some of those highlights, what we expect for affordability and inventory, for home prices and home sales next year. So here's the headline. We see the 2026 housing market as entering a next era. After 4 years of very slow sales and relentlessly rising prices, we have new trends finally taking shape. Inventory is sufficiently abundant now that home sales can finally grow again. And for the same reason, affordability pressures are starting to ease. Many of the distortions of the early 2020s are finally unwinding. So let me walk you through some of the key conclusions of the report. So let's start with affordability. Housing affordability reached its worst level in nearly 40 years in mid-22. Homes are priced roughly 25% above what might be traditionally considered affordable. So in this new era, incomes rise faster than home prices, and that changes the affordability dynamic. Add in gradually improving mortgage rates, and that accelerates the process. So in this chart, we have the price to income ratio, the median home price versus median income. That ratio peaked at 5.3 times income in 2022. By 26, with flat prices and incomes growing at about 4% per year, we project that drops to about 4.9. So here's the math. If prices stay flat and incomes go 4% annually, the market returns to traditional affordability levels over the next several years. We're already 3 years into this process in much of the country. Lower mortgage rates only accelerate that timeline. So we expect mortgage rates to trade in a range of 5.9% to 6.9% in 26, averaging around 6.4. That's 40 basis points lower than most of the year in 2025. The labor market will probably be the swing factor here. Weaker employment likely helps push rates lower. Hotter inflation would keep them higher. So every time rates have dipped close to 6%, anytime in the last 3 years, buyer demand picked up noticeably. So if we spend time in the low sixes next year, that's bullish for sales. So the takeaway, though, on affordability is you don't need a crash to see improved affordability. You need time. Time is working in buyers' favor. Now let's talk supply. We forecast about 10% inventory growth in 2026. In this chart, you can see we're projecting inventory to climb through the summer and peak about above 1 million single-family homes for the first time since 2017, before retreating in the fall. And so why do we expect continued growth? Well, 3 years of elevated mortgage rates have been building supply. The Sun Belt in particular has seen massive inventory increases. Texas has 50% more homes on the market now than in 2019. Florida has abundant selection. But here's what's important. The pace of growth is moderating. Earlier this year, inventory was up 30% over the prior year. Now it's close to 15% and still compressing. So we're also seeing the mortgage rate lock-in effect start to fade a little bit. So nearly 20% of all outstanding mortgages now carry rates above 6%. Those homeowners aren't anchored to a rate they'll never see again. They're more willing to move. That adds to supply, but it also adds to demand since most sellers are also buyers. The regional picture matters a lot here. Sunbelt markets have plenty of inventory, but places like Chicago or the New York tri-state area and much of the Northeast still have 50 to 60% fewer homes on the market than, say, in 2019. For sales to really grow in 2026, we actually need new listings to pick up in these tight markets. The takeaway is that inventory seems sufficient to support sales growth and keep a cap nationally on price appreciation. But inventory is not accelerating out of control. That brings us to the next big one, home prices. Our baseline forecast calls for essentially flat home prices in 2026, up just 0.5%, with a plausible range of negative 3.6% to positive 4.6%. And how do we arrive at this? Well, we have a model that links changes in supply today to price outcomes of following year. The relationship is pretty consistent. Inventory rises, future price appreciation slows. When inventory declines, prices accelerate. So with inventory averaging 27% higher in 25 than the prior year, the model projects minimal price growth in 26. Now, flat prices would actually be pretty unusual. Most years, home prices appreciate by 4 or 5%. A flat year only happens after multiple years of slow demand, and that's exactly what we've had. So 11 of the 20 big markets tracked by the Case-Shiller Index, for example, already show year-over-year price declines. Tampa, Miami, San Francisco, Phoenix, Dallas, these are all already negative. The remaining markets are decelerating with prices. So when we apply the model state by state, we can see 13 states projected to have negative price changes in 26, mostly Sunbelt states with elevated inventory. Meanwhile, tight inventory states like Connecticut, New Jersey, Minnesota should see continued modest price appreciation. But here's the key. Flat is how affordability returns. Flat prices combined with rising incomes gradually close that gap. So the takeaway for prices is expect a stability, not appreciation. In some markets, prices will dip and already have. In others, they'll inch higher. National averages will mask the sharply different local realities. Finally, our home sales forecast. Home sales enter 2026 with actually the strongest forward momentum since the pandemic. We're forecasting home sales to rise from close to 4.1 million to approximately 4.25 million, about 5% sales growth. So why the optimism? Well, the weekly pending home sales have been consistently running above 2024 levels for months. The purchase mortgage applications are up about 15 to 25% year over year. Pent-up demand is building. So surveys show the share of homeowners who want to move within 2 years has jumped from 10% to 25% since 2022. And there's actually a credible Goldilocks scenario where sales could reach as high as 4.5 million, 10% growth this year. And I've illustrated that here. That would require mortgage rates staying near 6 rather than 7, the labor market holding up rather than deteriorating, and some of those frustrated sellers who withdrew listings in 25 finally completing their transaction. So one surprising contributor to this Goldilocks scenario where home sales grow a lot in 26 is the withdrawals. So withdrawals of 2025. Withdrawal listings have been elevated all year. It's tempting to look at these withdrawals as sellers who want to sell but failed and think of them as shadow inventory. But we estimate 150,000 withdrawals in 2025 that could really be 2 transactions in 26. So if we get lucky with all the variables. And since most of the withdrawals are owner occupiers rather than like investors, so every withdrawn listing represents two transactions, a sale and a purchase. Most sellers are also buyers. So withdrawals actually reflect shadow demand rather than shadow inventory. If conditions improve, those could activate in 2026. So the bear case, though, is if inflation heats up and rates push back towards 7%, or if job losses accelerate and buyer confidence crumbles, that could stall sales growth. The takeaway, though, the ingredients for stronger sales year are in the bowl, and we'll see if they mix together just right. So let me leave you with this. We've entering a new era for housing. In this era, home sales can finally grow again. Affordability is finally improving. The market is finding its footing after 4 years of this disruption. If you're a buyer, 2026 offers improved conditions, especially in the Sun Belt. More selection, more leverage, gradually improving affordability. If you're a seller, it makes sense to probably pay attention and realistically price from day one. Over 40% of listings nationally have taken price cuts now, so the market rewards preparation. So the full 70-page report, our Compass 2026 Housing Market Outlook report, is linked below. It has all the data. It has a detailed analysis. I hope you check it out. And I will be back next week with our regular weekly update. See you then.